Welcome to Money and Metals. China's money rates dropped sharply last week. The Chinese money rates fell sharply for the second week in a row as the central bank lowered its guidance for the 7-day repurchase agreement. Despite a series of easing measures by the Chinese central bank since last November, short-term interbank rates have remained worryingly high until the past 10 days. Analysts cited lower central bank foreign exchange purchases due to the rising dollar and short-term margin borrowing by speculators in China's stock market as key reasons for pushing rates up. The People's Bank of China cut interest rates on February 28th in its latest effort to support the economy as momentum in China slows. In other money news, the U.S. money fund asset posted its biggest weekly rise since 2013. U.S. money market assets rose $32.2 billion to $2.7 trillion in the week ending March 24th, for the largest single-week increase since October 2013. The jump followed the previous week's $19.5 billion decrease, stemming from withdrawals for corporate tax payments. Money market funds are huge holders of ultra-short government debt securities. We can look at this rush into U.S. money fund assets as actual verification of safe haven status. A lot of people are parking their money, institutions, etc., into the U.S. dollar in very short-term treasuries as a way to maintain safety and liquidity. So certainly the idea about where the financial markets are going in the near term shows that there's a lot of people waiting on the sidelines in cash. And this is, again, verified by the fact that we had one of the biggest weekly rises in quite some time. The ECB's Draghi says that money printing is already helping the recovery. Bond buying by European central banks will reinforce the Eurozone's economic recovery, its President Mario Draghi said last Thursday, adding that there was already evidence that this scheme was taking effect. He says, quote unquote, monetary policy is reinforcing the cyclical recovery. I insist in saying cyclical because this recovery is not structural, end quote. He told a parliamentary committee hearing in reference to long-term problems such as large unemployment. Draghi also gave his encouragement to efforts in Italy and other countries to reduce billions of euros that had bad loans in the banking systems and are holding back lending and creating an obstacle to economic recovery. Speaking to a parliamentary committee hearing in Rome, he said there needed to be a rapid solution to the problem of impaired loans in the Eurozone overall. Moving on to the metals, China should boost gold reserves to 5%, says the World Gold Council. China should increase its gold holdings to around 5% of its total foreign exchange reserves to help diversify its currency, according to the World Gold Council. China currently holds 1.6% of its foreign exchange reserves in gold, which is relatively low compared to developed countries and some developing countries. World Gold Council Chair China Managing Director Roland Wang stated. The ideal amount should be 5% of its total forex reserves, Wang told Reuters in an interview in Hong Kong. So I'll pause here and state that certainly that's a report and it can be verified. It was produced by Reuters, but there are many other analysts that have a much different take on the total amount of gold that has gone into China and what the actual amount is versus their foreign exchange status. So that's something to bear in mind. This is one side of the story, certainly verifiable. The other side's not as verifiable, yet certainly merits your consideration. In other precious metals news, gold extended its gains in its longest rally since 2012. Prices gained for the seventh straight session last week, and gold briefly touched the $1,200 an ounce level, at its highest level since March 6th. There is some resistance around the $1,200 mark, and we'll have to wait and see what happens in that area. Traders said gold's 100-day moving average is about $1,209, and that's a key level to watch. The dollar eased against a basket of major currencies as disappointing U.S. economic data added to the Fed's dovish stance last week. Softer economic growth could prompt the Fed to delay raising interest rates, and that's a move likely to take some of the steam out of the dollar. Safe haven gold also drew support from geopolitical tensions with what's going on in the Middle East between Saudi Arabia, Yemen, and basically everywhere else in that region. And finally, investors remain cautious over the current outlook with the Spider Gold Trust, the world's largest gold-backed exchange, continuing to see outflows. The fund's holdings fell to 743.2 tons last week. And in silver news, Hochschild says silver recovery is dependent on investment buyers. Chief Executive Ignacio Bustamante of Hochschild was interviewed by telephone last week and stated a collapse in silver prices is putting a squeeze on producers such as Hochschild, which reported an annual loss last week. The precious metals have fallen for 2 straight years as the dollar has strengthened, reducing demand for alternative investments as an inflation hedge. Silver currently is selling under the $16 level compared to more than $49 in 2011. Silver Wheaton, the largest precious metals mining financing company, said December that about 50% of primary silver mines do not make a profit at $19 an ounce, and mines will close should prices remain depressed. Hochschild, which operates in Peru and Argentina, posted a net loss of almost $70 million for 2014 compared to $123 million the previous year. It sought to cut expenses in response to lower prices and forecast an all-in sustaining cost of $15 to $16 an ounce for this year, 2015, down from the $17 level that it had for operations in 2014. So the outlook for metals prices, according to Hochschild and others, remains rather dim, and I tend to agree with that view until later in the year. And last bit of news to report this week is SOGEN, the Société Générale Bank of France, was very, very negative on the metals this last week, stating very low prices they see ahead. You can take that as an indicator or not. Certainly something to think about. And that's it for this week in Money and Metals.